Safeguard family, it's great to be back with you with our first quarter 2024 market update. The markets continued momentum from 2023 as we started the first quarter, filled by hopes of 6 potential rate cuts from the Federal Reserve. But let's backtrack a bit. The Fed had hit the pause button on rate hikes, but hadn't hinted at any imminent cuts. Despite this, the market was convinced of both the Fed's ceasefire and the likelihood of rate cutting spree. Employment was still going strong at the beginning of the first quarter, so one of the Fed's measures to determine whether or not to cut rates was not trending very favorable. The Fed will feel better about dropping rates if we see unemployment in the 4 to 4.5% range. We're not there yet. However, we haven't been above 4% since November of 2021. The other metric of inflation or price stability has come down from its 40-year high of 9.1% in June of 2022. However, it has been stuck between 3 and 3.7% since June of 2023. So the stated 2% goal hasn't been met. That was the backdrop going into the first quarter. The Fed was done and going to cut rates, and consumers were still spending. The market soared to new record highs with tech companies leading the way. However, reality kicked in when Fed Chair Jerome Powell suggested a more modest approach, hinting at possibly 3 rate cuts starting in June. Markets didn't like this news, and the magical mood was broken momentarily. However, as they shook off the realization that 6 cuts were off the table, they chose to focus on the stronger than expected earnings and the notion that rates were far more likely to decline than go up. They also liked that the economy was hanging in there and not headed into a recession. Each piece of economic data was examined for what kind of impact it would have on the Fed's next move. Markets liked what they saw, and the data was encouraging enough to keep them moving upward throughout the quarter. Gross domestic product, or GDP, for the fourth quarter of last year came in at a strong 3.2%, and a real GDP was at 3.1% for 2023. So interest rates haven't resulted in a significant economic slowdown or recession yet. The markets reasoned that if current rates can sustain the economy at those levels, then stocks will continue to perform well, no matter how many or how few rate cuts we see this year. We ended the quarter in equities much the same way we began, with markets breaking records nearly every week. After a pretty strong 2023, we estimate GDP for the year will end at around 3%. The estimate for the first quarter of GDP is in line with that 3% that we ended 2023 at. The first quarter advanced estimate for GDP will be reported on the 25th, so we'll see how close we get. Rate curves have remained inverted. However, as recession has yet to occur, and almost all market observers have been wrong. This has been the most predicted recession to never occur. Once the Fed begins to cut rates, bonds should rally. However, the age-old question is, when will that begin, and what can you do to take advantage? I still believe bonds will pay off in 2024. Still, the first quarter was good for stock investors. As we enter the second and third quarters, I expect markets to have a little more volatility, similar to what we saw last summer. We have banked significant gains in the first quarter, and people will start fretting and will be hypersensitive to any economic news that may alter the narrative of what's expected from the Fed. Just to be clear, expectations are for cuts to start in June. Any economic data that may cause the Fed to delay or even change its tune or consider rate increases could create some volatility. On the other hand, if unemployment rises above 4% and hovers below 4.5%, the markets will continue to rally, since it most certainly would mean the economy is weakening. In that case, the Feds would need to lower rates to keep things going. I still believe 2024 will be a solid year for the stock market. A strong first quarter is usually good sign for the rest of the year. In the last 40 years, the S&P 500 delivered 28 positive first quarter results, which are a good predictor of how the rest of the year ends up. I expect we could add another 7 to 10% from these levels, and there will be likely bumps along the way. However, the economy is still seemingly solid. The summer may have volatility, and we might have a pullback. However, markets likely will continue to rally as we head into the fall. Please understand that this is just my expectation given all we know right now, since the environment can always change quickly. Staying the course and being disciplined with an overall plan will reward the disciplined investor over the long term. Stay diligent, review your plan and vision with your advisor. Remember not to succumb to emotion, because that's usually a surefire way to get off track from your vision and your plan. Enjoy the warmer weather and have a happy spring. And please reach out to your advisor if you have any questions. Remember to like, subscribe, and share this video. I will see you guys next time.